It's a privilege to be here with you today, and my intention is to give you some insights into how to turn your business into a precious and valuable asset. We'll be talking about business exit planning, and this is all about optimizing your business to maximize its value prior to executing a successful exit process, such as a business sale. But before we start talking about that, I want to get a bit of a gauge of who's in the audience. So I want to get you to raise your hands if you currently own a business. Can I see a sign of hands? That's about 85%. Can you raise your hand again if you had your business for 5 years or more? That's about 60%. Can you raise it one final time if you've owned your business for 10 years or more? Maybe 25%. There's a lot of hard work and sacrifices gone in building businesses in this audience. So that gives you a bit of an idea of the history. Now I want to get an idea of your thoughts going forward. Who wants to sell their business? Can I see a sign of hands? One day. Who wants to sell their business one day? Probably about 30-40%. Who wants to sell their business in 10 years, within the next 10-year period? That's probably pretty much the same. Who wants to sell in the next 5-year period? Well, the people wanting to sell in the next 5 years, this is really opportune to have a look at this presentation. All right. Now, whether you want to keep your business or sell it next year, sell it 10 years from now, or to maintain it for passive income, it's important to start to turn your business into a valuable asset. I'll give you a quick view of my journey into business exit planning. And it all started about 15 to 20 years ago when I was working for the Foster's Group. At that stage, Foster's, the alcohol company, was quite aggressive in the marketplace. It would buy smaller businesses because they liked what they were offering or to stop them from becoming competitors. But it was always very careful to make sure the tail didn't wag the dog. It kept these businesses to the side so it didn't disrupt the focus on the CUB beer empire. And what it would do, it'd send someone like me to look into these businesses, and I'd go in there and make sure the strategy was sound, make sure the management team was complete, work on the business owner to make sure they started documenting all their knowledge. And we'd normally go through a business cycle for 2 or 3 years. So we'd do a strategy, produce budgets, and have that monthly review of performance. And at the end of 2 or 3 year period, Foster's would determine, is this a business we want to keep, and do we want to integrate it into one of our divisions, or do we want to sell it in the marketplace? So I did this twice when I was at Foster's, developed some really good skills about business optimization and structuring businesses for sale. Then about 6 years ago, I was general manager of another business, and the owner decided he wanted to go to the market. And I looked around for a holistic service provider who could help manage all the issues that you have when you're going through this complex and difficult process of optimizing and selling your business. I could find an accountant to help me to normalize my books. I could find solicitors to help me to write commercial contracts and a broker to help me with the sales process, but I struggled to find someone who'd give me the whole holistic offering to help me through the process. So I basically did some research and did some study with some overseas educational facilities and came up with my own offering about business exit planning. And now within Outcomes, we can offer this sort of facility for our clients. Okay, so what are the 8 key drivers of business value? Through extensive market research with business owners and M&A professionals, 8 key drivers were identified. And this is all about profitability, growth, and risk. So let's go through them individually. The first one, financial performance. It's easy to say, harder to achieve. Does your business make money? Buyers are interested in businesses which are profitable, but also a proven record of profitability. So obviously this is a key focus. The next driver is your growth potential. You get a real premium in the marketplace if you have a growth story. So does your business have a bright future? You need to have a growth strategy plus implementation plans to deliver on that, and that will give you this premium in the marketplace. The next value driver we'll look at is over-reliance risk. Does your business rely heavily on a key supplier, a gun employee, or a major customer? Buyers are looking for diversity across your customer and your supplier base. And if you have a gun employee, such as a great salesman, what have you done to tie them to your business long term? These are all risks. On to cash flow. Cash flow is important because some businesses produce excess cash, but other businesses need a substantial working capital base to keep their business ticking over while they wait for the checks to come in. And in the end, a buyer needs to write 2 checks. The first check to purchase a business, but the second check to fund the working capital. So if you have a sizable working capital, that'll reduce the amount of money that the buyer has to purchase your business. Going on with your drivers, we've got future recurring revenue. How certain is that pipeline of sales into the future? Buyers are looking for certainty in terms of your sales profile. And if you have measures in place that gives more certainty, 10%, 20%, 30% of sales will just generate automatically through things such as long-term binding contracts or maybe a monthly subscription model that just keeps rolling over. They're the things that will attract buyers. On to business differentiation. How defendable is your position in the marketplace? This is important. Buyers are looking for businesses with unique and meaningful offerings, because if you have a niche in the marketplace, this means that you're not competing with other businesses on price. Customer satisfaction, of course, is key to a buyer, because a buyer wants to know how likely it is that your customers will repurchase from you. Also, whether a customer will refer you on to others. But many businesses claim they have great customer satisfaction ratings. They give great customer service. So how can you substantiate that? We recommend the Net Promoter Score. It's an internationally recognised measure of your customer satisfaction. So put that down, everyone. Net Promoter Score, and have a Google of that. And last but not least, your key person risk. How reliant is the business on the owner? Is the owner performing some critical day-to-day transactional activities within the business? Are they the major salesperson for the business? These are the things that reduces your value. If you are doing those sort of activities, you need to start to document your processes and procedures and work out how you can replace yourself. A good test of how dependent the business is on the owner is to take a short break. A week, 2 weeks, 3 weeks. Leave the business to manage in your absence. And there will be some issues, but you'll probably be quite pleasantly surprised at how things go. But when you find the deficiencies when you come back, that'll be a result of inadequate training or gaps in your procedures. So they're the key risks that you need to address in order to make sure that the buyer is interested in your business. Often business owners also ask me, when is the best time to sell my business? It's a good question. And it's important that you understand where you are in your business life cycle. So all businesses go through a life cycle. It starts up here in the startup phase, where you're trying to work out where you've got an offering that actually customers are interested in. And then when you get your sales and marketing models going, you start to get into the growth phase. Maturity, you probably rely on what you've done in the past, and then death and decline. But irrespective of what asset class you're dealing with, whether it's property, whether it's shares or a business, it's important to sell your business when its value is at the highest. So when is that for a business? It's here at the top of the growth cycle. Does that make sense? It's at the top of the growth cycle because not only is your business performance good, but your growth trend is at its highest. If you did a trend line here, you'd probably find that that's double digit. And what will happen is a buyer will anticipate that continuing into the future and will pay accordingly. So the best time to sell your business is at the top of the growth cycle. If you miss that, you can still do well in the maturity stage. But here, although you've got good financial performance, you don't have that growth factor anymore. Your growth rate would probably be just 2 or 3% by this stage. So you've lost that premium that gets paid for growth. Unfortunately, many business owners don't understand where they are in their life cycle and miss out on that, and could end up looking to go to the market while they're in decline. It's very hard to sell your business when your revenue is going backwards, where your profit is negative, and your growth is negative. It's very hard to sell your business at this stage. It ends up being more of a fire sale. So it's important to know where you are in your business life cycle in order to maximise the best opportunities for yourself going forward. Business owners often say they don't have the time, they're too busy to spend improving the value of your business. But I ask you, how would you be in 5 to 10 years' time when you realise your business has no value because it's well past its best before date? So you need to continually try to improve the value of your business. Well, now, there's an old saying that all business owners will exit their business. It's a question of how, when, and why. So here we're looking at the how of exiting your business, 6 different options that we'll go through. So the first one is to retain your business for passive income. By this we mean that you actually retain the ownership, but you bring in another management team to run the business, and you use the profits as passive income to live on. It's a good option for many owners. You've got some risk, that is you have to rely on the good management team, and also if the market changes and the business doesn't adapt to the changing marketplace, you can be left out. The next option, family transition, very popular with family businesses. By this we mean intergenerational transfer of both ownership and management of a business from one generation to the next. Typically this is from parent to son or parent to daughter. If you do want to go through a family transition, there's 4 questions that you need to ask yourself. The first question, are your children actually keen to run the business? Are they willing? The second question you need to ask is, are they capable of running the business? The third question that's pretty important for the business owner is, are you willing to let go, to give them a chance? And the last question you need to consider, does the family support your choice? Okay. Next, we want to have a look at internal business sale, which produces a good result for a business owner in that they don't have to go through the arduous due diligence process. And this is because the buyer of the business actually knows the business because they're already involved. They're either a partner, part of the management team, or an employee. So it gets a good result without necessarily going through the full due diligence process. But the best result is achieved through an external business sale. What you want to do here is to get a number of interested parties and to build some competitive tension to maximise your price. But this will require a full due diligence process, as the potential buyers will want to check out all the business fundamentals and assumptions. Liquidate your business. Unfortunately, this is where most businesses end up. Most businesses never sell. Most businesses, the owner is left with little choice but to close the door and walk away. But even liquidating your business is an expensive process. You've got employee entitlements that you need to pay out. You've got a lease that needs to run out. You've got make good on the property. You've got a whole series of assets that you need to try to get some value for, which often end up in a fire sale. And last but not least is the unexpected death or illness. No one wants to make contingencies for this, but it is sensible if you can have some plans in place that you share with your family, maybe even your management team, in case the worst happens. How you can manage that business to get some value out of it after you've moved on. All right, so that's a bit of an idea about the business exit process. But business exits are difficult. And why is that? Why is it that most businesses never sell? Well, there's 2 key reasons. First of all, most business owners never have a plan and they just stumble through the process. And the second reason is buyers are just not interested in risky businesses. If you haven't reduced your business risk, then you're not attractive to a buyer. And you see there, 80% of businesses do not sell according to the Bond University. So what can we do about this? What we recommend is a business exit planning process. We use a simple 4-stage model to help you here. Stage 1 is all about planning for the exit. We develop a blueprint, and this is based on questionnaires and interviews with the owners of the business to identify the next steps. And this will produce both business exit plans needed to minimise risk and optimise the business, but also personal actions that you need to do to protect the business and move forward. Stage 2 for us is all about making sure you've got the right foundations. We call it protecting the existing wealth. And this is where we make sure that the owner has got his estate planning in place, understand his financial plans and his requirements going forward, to do an insurance review, to do a structure review, and even a taxation review to make sure that he's got the business structured to minimise any tax. Stage 3 is all important. This is where you optimise the business value. And stage 3 is all about addressing those 8 key drivers that we talked about at the beginning. Minimising those risks, whether it's over-reliance risk or it's key person risk, to make your business attractive. And stage 4 is executing one of the exit options, whether it's retain for passive income by bringing in another management team, internal sale, external sale, or a family transition. I hope that makes sense. So what I just wanted to say to you is that exit planning does pay off. It's a win-win situation. It's a win for you because you get a fair price for your business. It's a win for the buyer of the business because you've de-risked the business with all the assets. And it's well worth moving forward that way. And just what I wanted to say is we have an offer today for anyone here attending, all the attendees today, and there's a complimentary consultation about business exit planning. We'll sit down with you and review your business along those 8 key drivers of value and work out how you can build an exit plan. Thanks for your time. Cheers.